Good morning, folks, and welcome back to Almus Market Mornings. I'm sure all of you, just like me, are wondering what happened. Since the previous week, the markets have observed sharp dollar selling emerging due to central banks' resolve to shore up the rupee. On Friday, we saw rupee gain beyond rupees 90, trading as high as 89.26 against the dollar. All of this has happened at a time when global markets have been relatively calm as the Western markets go on a Christmas break. Good morning, JK. Tell us about this intervention. Do you think now things should start stabilizing, and where do we see rupee headed from here?
Oh, good morning, Raj. Uh, yeah, so I think yeah, once again, as we shared on Thursday also, uh, RBI has been trying to stabilize the rupee. Uh, at the same time, they are doing that without spending too much of their reserves. That's the reason why you see their action coming just at the beginning of the market or just before the market or on Friday when no one expected. Uh, so they intervened just before the close of the market when the market is illiquid and it's already year-end time. So the participation is less. With the spending of less reserves, they were able to you know stabilize the rupee or rather bring down the rupee spot to a much lower level and traveling from 9110 to 8926. I think we have already seen the rupee appreciate by about 2% with much lesser reserves than they spent when they were defending the 88.80 levels. So it's more of a stabilizing act that we are seeing and definitely not changing the overall direction. The overall direction can only change if there is a change in the big reasons which are driving the rupee lower, which has been the higher trade deficit and then lack of capital flows, as well as the eluding trade deal. All of this is actually keeping the rupee somewhat weaker. And of course, this is also happening when the dollar index itself has been on the weaker side. And we all know that RBI has net reserves of around 630 billion if you strip out the forward position that they have. So I think they are using their reserves judiciously. And one more thing also is that market has had a lot of long positions built, particularly in the offshore market. More by the speculators because they were looking at much weaker rupee going forward, particularly after 90 has broken, and that is that is where the target of the central bank was to remove those long positions to be unwound. And once certain levels are broken, the longs themselves take care of the market to correct deeper because they bail themselves out of the long positions. Yeah, what moving forward, what we can see, I'm not seeing still this as a new trend for the rupee. We should have some change in the fundamental drivers of the rupee to the positive side to see a meaningful or more sustainable recovery. Or technically, there is a good support just below 89. We all know that 8880 was being defended by RBI for quite some time, and now that which was a resistance earlier now becomes a support for the market. So just under 89 is where I think very good support will be there. Apart from that, we also have seen seasonally end of December we see a lot of debt outflows both from private and the government side. So these outflows could also see the spot being well supported. Whether we break further down or not depends on some new further developments on the trade, or if the new year will see fresh inflows from FIIs, or rather resumption of FII inflows. So far for this year, we have only seen a large amount of net outflows. So these conditions are not, we are not seeing signs of these things. Therefore, it is it is safer to assume that the rupee will not strengthen too much from here. Even I don't think RBI would be intervening too often in this way to make the market even more artificial. So I think importers would do well to take advantage of any move near 89. And of course, exporters can wait out a bit on the maybe at least 90 levels to take some hedges. See, now we are in a thin market in New Year Eve. Only thing that moved on Friday was the Japanese market. Japanese central bank hiked the rate by 0.25%, as most had expected. And the press conference from Ueda, the Bank of Japan governor, was somewhat dovish, I would say. He did mention about the need for further normalizing the rates, but was not committing on when the bank would be doing that. And market took it as a slightly dovish message. Secondly, even with the 0.25% hike to 75 basis points, the Japanese rate remained very low relative to other major currencies. So we saw the yen move down from 155.50 to 157.70. So that was a telling part of the move. On other instances, when the Japanese had hiked rate, yen had tended to strengthen, and this was completely reverse. And if they do, take a long gap in hiking the rate again, we might well see the Japanese yen becoming funding currency for risk trades once again. But in the meantime, one market has not given up its trend, or rather, I would say a couple of markets. One is the Japanese yields. The Japanese 10-year yield has now touched a new high of almost 2.1%. That's a 28-year high. So that trend has been continuing, and it's quite surprising that Japan has not intervened in the bond market, but that too in a thin market when the things can get exaggerated. But that yields going up in Japan could have probably stopped the yen from falling too far. The market is now caught between overall lower interest rate, lower official interest rate, at the same time the rising yields, which can actually raise the funding costs. So that's one dilemma that the yen traders are now facing. However, once the Bank of Japan steps into reining the yields, then probably we would see the Japanese yen weaken a bit more towards 158 or 160 levels also. In other currencies, hardly any movement is seen because of the year-end factors, and we are just a week away from the year-end. And gold, of course, gold and silver have made a new high today. Just above the previous high was seen in gold, and silver, of course, gain of 1 to 2% every day has become very normal. Even the platinum. So the preference of investors to acquire more of resource-based assets than fiat currencies has been a feature that has continued. And of course, because of the year-end conditions, once again, these move also get exaggerated. Yes, so I think we stock markets, of course, are, I think, slowly getting into a narrow, rangy mode, and that's very much par for the course, because we've seen large moves, large swings in the markets this year. So yeah, I think we are moving ahead into the new year with limited moves. But Rupee is definitely one to watch, whether it turns around more decisively, or continues with its trend of weakening as seen in 2025. That will be very much on the minds of our markets. Thank you.
Thank you, JK. And yes, I think towards the end of the year, there is a lot of activity happening, especially domestically. We are looking at the sharp interventions by the central bank when volumes are already thin due to the Western markets going for a Christmas slash New Year holiday. But it definitely seems like a intention to liquidate all the excessive speculative long dollar positions against the rupee, and that's seems to be the primary aim. for this particular activity. Apart from that, Japanese central bank hiked rates point two by 0.25%. The chief Ueda seems to be somewhat dovish in his press statement. And interestingly, we are seeing the yen weaken despite this rate hike. Japanese yields are at a 28-year high at 2.10%, the 10-year. The trend has been quite strong with no intervention there by BOJ. Otherwise, things remain quite range bound in other currencies. Gold and silver continue to make a new high. Both remain in a strong trend, and even stocks are broadly in a range bound move. That's it from us today. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.